Hi, Vic Joshi, C2 Financial, home of free mortgage consultation. People are feeling some anxiety over the new president and what that's going to mean for real estate and mortgages. We did see interest rates go up 0.5% on election day, and then rates were up about 1.25% in the following weeks compared to where they were prior to the election. Things have calmed down a little bit since then. Rate-wise, we do know that the Fed is interested in increasing interest rates 0.75% this year, but they said something similar last year where they wanted to increase 1 percentage point, and they ended up increasing rates by 0.25%. So we'll see what happens. Most of the voting members in the Fed are a little bit conservative when it comes to interest rates and increasing rates. I think we have only one really strong voting member who is aggressive about increasing rates. So we may or may not see 0.75% increases this year. Time will tell. The one thing that the president is doing already is he's going after the Frank Dodd Consumer Protection Act that was put in place in 2010 that has created a very conservative lending environment and has made it very difficult for people to qualify for and get mortgages. The result of the Frank Dodd Act is that the foreclosure rate is at an all-time low. I think we're somewhere under 0.5% on foreclosure rate nationally. So what the Frank Dodd Act was put in place to achieve, which is to bring more stability to the financial markets, definitely happened, but we've kind of gone maybe a little bit overboard on regulation, and the president's desire to roll back some of these regulations should help bring more mortgage products to the market to help more people who've been kind of locked out and frozen out of either buying real estate or being able to refinance their loan. We'll see how far back this rollback goes. Hopefully not too far, because of course these exotic mortgage products that existed prior to the recession were one of the key catalysts to bringing our economy down. But I am excited about the prospect of being able to offer more products and get more people into houses and help people who are in tough loans with high interest rates, maybe an adjustable rate mortgage or something like that, be able to refinance and gain stability in their mortgage. So one of the products that I'm starting to see come back into the market is a stated income loan, which is a loan where it's designed to help self-employed borrowers who write off a lot of expenses off their tax return, because currently the vast bulk of loans available are for people who have to qualify, self-employed people have to qualify with using the net income off of their tax return, which is whatever is left after all the write-offs, which tends to be a fairly small number for most self-employed people, because the whole goal, one of the goals of being self-employed is being able to reduce the amount of taxable income you claim to the IRS so that you're not paying that much in tax, and you do that by writing off expenses. Prior to the recession and the loss of a lot of these more exotic loan products, including stated income, a self-employed borrower could use their gross income to qualify with. And you know, that stated income product was actually geared towards self-employed borrowers. The thing that brought stated income down and gave it a bad name, the liar loan moniker, is that banks started offering these products geared towards self-employed borrowers to W-2 employees. And then you had things like McDonald's employees, claiming that they're making $50,000 a year or more on their tax return, on their loan application, and the loan officer going forward with that to try to get the deal done. Of course, there's a commission on every loan, so more unscrupulous loan officers were creating the liar loan phenomenon. So stated income coming back for self-employed borrowers, which is what it's meant for, is a good thing. Of course, a self-employed borrower who claims that they make a lot less than what they actually do by using the write-offs doesn't mean that they don't have the cash flow to be able to qualify for and pay for their mortgage. So stay tuned for more on stated income coming back for your self-employed borrowers, and we'll see what other interesting loan products come to market. Now, people who are in adjustable rate mortgages have started to come at me to try to fix their rate. They're a little bit late on that, unfortunately, but usually it takes seeing and feeling the effects of a rate increase to get people motivated. And we've started to see that people who are in adjustable rate mortgages that are starting to adjust in the last few months have felt an increase in their interest rate, whereas the previous 30 years or so, if you were in an adjustable rate mortgage and your rate was adjusting every year or every 6 months, overall your rate continued to fall. And so people in adjustable rate mortgages actually were winning over the last 30 years. Even though most people were taking a fixed rate loan as rates fell, because every time rates would fall, we would think, well, gee, they're not going to get any lower than this. And we hit that bottom in 2016 between the months of June and September. I don't think we're ever going to come back to that, especially with the Fed having started to increase interest rates in December of 2015 and having 2 rate increases over the last year and a quarter, year and a half. That's going to be the continuing path. The Fed has said that we're starting to hit their target 2% inflation rate, and so they're just going to keep rolling with that. I think rates will keep increasing overall for the next few years and maybe over the next 5 years. I don't know. Interest rates right now are kind of in the 30-year fixed conforming range, or in the 4s. I guess I have to say APR, but whatever, they're in the 4s, when last year they were in the 3s. And so that's going to be the trend going forward. Now, a 4-something% interest rate is still extremely low in the grand scheme of things. Over the last 40 years or so, the average interest rate has been about 8.25, 8.5. So anything below 8 is still considered a really good rate, and we're doing awfully well still this year, but I think things will continue to move in a different direction. If you're in an adjustable rate mortgage and you want to fix it, now's the time to do it. I've had a lot of people over the last 5 years or so do this, maybe some of them a little prematurely, but those of you who've been dragging your feet, it's time to get on board maybe, because I don't think we're going to see these adjustable rate mortgages do anything but go up when they start to adjust. So the other thing that I'm getting a lot of inquiries regarding is new home purchases. First-time home buyers in particular have feeling some anxiety over the rate hike and what it means to them being able to purchase a property. And I do believe that even this small shift in rate, up 0.5%, up 0.75%, is big enough that it's causing a lot of buyers who are on the fringes, who are barely qualifying at these extremely high price points that we're seeing, especially in California and the Bay Area in particular, are causing them to not be able to qualify anymore. And maybe those are some of the people that need to think about an adjustable rate mortgage to keep their rate low to be able to still qualify. Unfortunately, that might be the only path to home ownership for them for the time being, and take a chance, and hopefully their income stream will increase over time, and by the time their rate starts adjusting, they could either go into a fixed or refinance back into another adjustable rate mortgage with a fixed interest period. So I am getting some of that anxiety from home buyers. The one thing that I could say about a rise in interest rates is that it has the potential to cause the market to reverse to some degree as far as home prices are concerned. If we have less buyers in the market, then we have less competition on listings, you're going to have less multiple offers, and sellers may not be able to list their properties as high as they were before. Especially in the Bay Area, there's a phenomenon here of where the listing agent wants to lowball the list price to create a feeding frenzy and a bidding war, which is where sellers are gaining the most value in the sale of their property, is when multiple parties are bidding and upbidding $50,000, $100,000 over the list price. We may not see that as much anymore with less buyers in the market due to this rate hike, and so maybe we'll start to see property prices come down a little bit. The one caveat is that with Trump rolling back Frank Dodd, or trying to roll back Frank Dodd, I think I read somewhere that he was trying to roll back 75% of Frank Dodd, Consumer Protection Act. If we get back to having more exotic products in the market, of course the markets do forget over time what they did that caused things to collapse. Then we might end up with some even more fringe buyers coming into the market, which would again then cause a bit of a feeding frenzy again that the one we saw in 2003 to 2007, where we had a lot of people in the market who shouldn't have been because of the exotic loan products. But for the near term, until some of that gets unwound and we don't know what kind of products will come back, I think that the hike in interest rates could cause property prices to start to drop. I think that we've been running on fumes price-wise for about a year, and I think we'll start to see that effect this year, 2017 and 2018. So don't despair over a rate hike if you're a home buyer, a first-time home buyer, and someone who's sort of on the fringes of being able to buy, because maybe prices will start to come down in the next year or two, and then you might be able to have a better chance of qualifying using a normal fixed-rate mortgage. And as always, I am here to give free information and free advice, free analysis, so feel free to contact me whether we transact or not. My business model is predicated on giving free information, and I'm happy to do that all day, every day, whether we end up transacting or not. And even if you're not able to qualify for the mortgage you want and for the property that you want right now, we may be able to put you in a position in a year or two to be able to do just that by getting all your ducks in a row. Again, Vic Joshi, C2 Financial, and this is the home of free mortgage consultation.